All right, so there's this company called Unusual Machines, ticker UMAC. And if you haven't heard of it, that's probably because 6 months ago, it was trading at like $4. Today, it's sitting around $15. That's a 900% gain in a year. And the stock hit $23 at one point before pulling back. But here's the twist. This company is losing millions of dollars every quarter. They've got barely $8 million in annual revenue. And yet, the U.S. Army just placed an order with them. So did a defense contractor for almost $13 million. That's nearly double what they made last year in one deal. So what's going on here? Is this a legitimate defense play or just another hype stock that's about to crash? Let's dig in. Unusual Machines makes drone parts. Specifically, they focus on first-person view drones. You know, those racing drones where the pilot wears goggles and flies like they're inside the thing? It's a niche market, but it's also exactly what the military is starting to care about. They own two brands, Fat Shark, which makes those FPV goggles, and Rotor Riot, an online store that sells drone components to hobbyists. They acquired both of these from Red Cat Holdings earlier this year when they went public. Now, here's why this matters. For years, the drone industry has been dominated by China. DJI controls the majority of the commercial drone market, but the US government doesn't want Chinese tech anywhere near military operations anymore. So they pass laws like the NDAA, which basically bans Chinese drone components from being used by the Pentagon or any federal agency. And that's where Unusual Machines comes in. They're one of the few American companies making NDAA-compliant drone parts. Everything they sell is built without banned Chinese components. And right now, that's a huge advantage. Pretty wild, right? Let's talk numbers, because this is where it gets interesting. In the second quarter of 2025, they did $2.1 million in revenue. That's up 51% year over year. Not bad for a microcap. For the first half of the year, they hit $4.17 million, up 65%. So growth is there, but they're also bleeding cash. They lost $6.9 million in Q2 alone. Now, most of that loss was actually stock-based compensation. They handed out $5.5 million in stock grants, probably to executives and new hires. If you strip that out, the core business only lost about $800,000 for the quarter. Still not profitable, but not as scary as it looks. Their gross margin is improving too. It hit 37% in Q2, which is the highest it's ever been. That's because they're shifting away from low-margin consumer sales and moving toward higher-margin enterprise and defense contracts. In fact, 31% of their revenue now comes from enterprise customers. A year ago, that number was basically zero. So the trajectory is clear. They're pivoting from selling drone parts to hobbyists online to supplying components for military drones and commercial systems. That's a much bigger market with way better margins. But here's the kicker. They just raised $88 million in new capital. They did a couple of stock offerings this summer, and now they're sitting on over $81 million in cash with zero debt. For a company doing less than $8 million a year in revenue, that's an insane war chest. You see where this is going? So what are they doing with all that money? Two things. First, they're ramping up manufacturing. They just acquired a company called Rotor Lab, an Australian motor maker, for $7 million. They're also opening a new motor production facility in Orlando, Florida. Motors are one of the most critical components in a drone, and now they can make them in-house domestically. Second, they're hiring. They brought in a VP of engineering, a VP of supply chain, and a VP of marketing, all within the last 90 days. These aren't random hires either. The engineering guy founded a drone company. The supply chain guy comes from automotive manufacturing. They're building a real team. And then the orders started rolling in. In late September, they announced a $12.8 million order from Strategic Logics, a defense contractor. That's the single biggest order in the company's history. It's also roughly what they made in revenue over the last 3 years combined. The components are going into rapid reconfigurable drone systems for the military. And then in mid-October, the U.S. Army's 101st Airborne Division ordered 3,500 drone motors from them. The motors are going into something called the Attritable Battlefield Enabler drones. And here's the thing. The Army hinted that if this trial goes well, they're planning a follow-on order for 20,000 components in 2026. And just a few days after that, Red Cat Holdings, the same company they bought Fat Shark and Rotor Riot from, placed an $800,000 order for components. Red Cat makes military surveillance drones, and they need NDAA-compliant parts to sell to the government. So now, Unusual Machines is supplying their former parent company. That's the part most people miss. They're not just landing one-off contracts. They're becoming a supplier in the domestic drone supply chain. And as more companies and agencies move away from Chinese parts, that supply chain is going to need someone to fill the gap. Now, let's talk about the stock, because this thing moves like crazy. It went public in February 2024 at $4 a share. By December, it hit an all-time high of $23.62. Then it crashed back down to around $5 during a stock offering in the spring. Since July, it's been climbing again. It's up 67% in the last 3 months and 154% in the last 6 months. The chart shows a clear uptrend. It's trading well above its 50-day and 200-day moving averages. The RSI is around 60, which means it's not overbought yet. Volume spikes every time there's news, which tells you retail investors are paying attention. On October 27th, the stock jumped 20% in a single day on over 14 million shares traded. That's 5 times the average volume. Analysts are bullish too. The average price target is around $19 to $20, which is about 30% upside from here. Needham initiated coverage with a buy rating. Maxim Group did the same. These are small cap specialists, so they're betting on execution, but the sentiment is clearly positive. Now here's the thing though, the stock is extremely volatile. Its beta is estimated around 4.5, which means it moves 4.5 times more than the overall market. If the market drops 1%, this thing could drop 5%. And it has a history of boom-bust moves. It went parabolic last year, then gave back most of those gains. So if you're thinking about this stock, you need to be comfortable with wild swings. Let's talk risks, because there are a lot of them. First, the valuation is insane. The company has a market cap around $480 million, but they only did $7.7 million in revenue over the last 12 months. That's a price-to-sales ratio of 62. For context, most hardware companies trade at single-digit price-to-sales ratios, so the market is pricing in massive growth that hasn't happened yet. Second, dilution. They've issued a ton of stock to raise capital. At IPO, there were only 1.25 million shares outstanding. Now there are over 30 million. That's a 24x increase in just over a year. So even if the company does well, your slice of the pie got a lot smaller. Third, they're not profitable. They're burning through cash, and they'll probably keep losing money through the end of 2025. They've got plenty of cash now, but if they don't hit their growth targets, they could burn through it faster than expected. Fourth, competition. They're tiny. They've got maybe 50 employees. Meanwhile, there are big defense contractors and other startups all trying to fill the same gap. DJI is still the dominant player globally, and if US policy changes or if Chinese companies find loopholes, the demand for NDAA-compliant parts could dry up. And fifth, execution risk. They're scaling up manufacturing fast, opening a new factory, integrating an acquisition, ramping up production. Any hiccup, any delay, any quality control issue, and they could lose credibility with their military customers. And those customers don't give second chances. So here's my take. Unusual Machines is basically a bet on 2 things. One, that the US government is serious about decoupling from Chinese drone tech. And 2, that this tiny company can actually execute on building a domestic supply chain before someone bigger steps in. The opportunity is real. The drone market is exploding. The military is pouring money into autonomous systems, and there's a clear policy tailwind pushing agencies toward American-made components. If Unusual Machines can scale production, deliver on these contracts, and land more orders, this could turn into a legitimate defense supplier. But the risks are just as real. The valuation is sky high. They've diluted shareholders heavily. They're not profitable. And they're competing in a space where failure means losing government trust forever. So, is this a buy? Not yet, in my opinion. It's more of a hold and watch situation. If you got in early, congrats, you're up big. But at current prices, you're paying a massive premium for potential that hasn't been proven yet. If you don't own it, wait for a pullback, or wait for proof that they can actually deliver on these contracts consistently. Q3 earnings are coming up on November 13th. That's going to be a huge test. If revenue is accelerating and margins are holding up, maybe the story holds. If they miss, this thing could drop fast. For speculative investors with high risk tolerance, you could nibble on a pullback, but keep the position small. This is not a blue chip. This is a moonshot. Unusual Machines is a classic David versus Goliath story. A scrappy American startup taking on China's drone giants with the Pentagon's backing. It's high risk, high reward, and right now the market is betting on the reward, but the risk is just as big. So yeah, while everyone's chasing the big AI names, it's these underdogs with government backing that might surprise everyone, or they might blow up. We'll know soon enough. Hope this video helps you on your quest for profits. Catch you on the next one.